Private equity real estate funds have become more and more popular, but they are not exactly new. Real estate syndications also have existed for decades. Do you know, for example, that the Empire State Building was bought through a syndication in the 1960s? Real estate funds come in two different flavors: REITs, real estate investment trusts, and private investments. Private investment funds allow you to invest alongside a small group of other investors, while REITs offer publicly traded stocks that represent an ownership stake in a larger pool of properties around the world. Commercial real estate has always been considered an alternative investment, but it is fast becoming more and more mainstream. Aside from buying an entire storage facility or a small multifamily complex on your own, another more affordable entry point into commercial real estate can be found through real estate investment funds. These funds appeal to investors who want to own commercial property but would rather be passive in their investing approach, meaning they do not want to directly participate in property management activities. Investors pool money to purchase assets within the fund. The fund's sponsor then directs all of the fund's operations, including property management. Real estate funds are a fantastic strategy for individuals who want to generate passive income by investing in real estate but don't want to be responsible for the property. So let's get to it. What is a real estate fund? Real estate funds are a mutual investment entity. Mutual investments allow investors to invest any amount of money they choose toward numerous properties at the same time. This way, investors avoid the need to have the entire capital amount that would be required to invest in whole properties as an individual. Investors can purchase a portion of several properties in the form of shares. These funds combine money from investors and give them the opportunity to explore. Investors may choose from a wide variety of funds, each with its own targets. For example, some real estate funds focus on large residential properties, while other funds might be focused on commercial properties that can be sold quickly. Rules for each fund vary, but generally the funds offer investors the chance to invest in real estate at a lower price point than in syndications, maintain liquidity since shares can be cashed out early, and of course, the opportunity to earn passive income when rent is paid on the properties and when the value of real estate increases. Types of real estate funds. As you look deeper into real estate funds, you will notice two main types of real estate funds. The first type is a private equity real estate fund. Private equity funds are not open to the public and have more restrictive membership criteria, such as high net worth or an institutional affiliation. The second type is a real estate investment trust or REIT. Real estate investment trusts are publicly traded. Although there is a cost to the investor, REITs offer liquidity and can provide diversification within your portfolio. Now, real estate mutual funds are exempt from registration with the Securities and Exchange Commission or the SEC, and they are exempt under what is known as Regulation D, Rule 506. REITs are corporations that invest directly in commercial real estate, and when you invest in a REIT, it's like buying stocks where shares can be purchased and sold. REITs and other securities have to be registered with the SEC. They can seek exemption from the SEC, but this process is costly, complex, and time-consuming, therefore not typically done. How to invest in private equity real estate funds? Once you connect with a firm or sponsor who is offering an investment opportunity, you have a couple of choices as to how you can invest your capital. You can either send in capital you have saved in a bank account, or you can invest using your retirement savings, wire liquid funds. If you have saved your investment capital in a bank account, you can simply wire the entire investment amount to the sponsor, according to the instructions provided in the investment documentation. The sponsor will then buy shares in the fund on your behalf and list them in an account that is maintained at the transfer agent. The self-directed IRA is one of the most popular ways to access real estate investment funds. This version of an IRA isn't much different from a Roth IRA. Self-directed IRAs are more popular because they allow the investors to invest in a wider range of assets, such as real estate investment funds. But also this means it's 100% up to the individual to do the research and conduct thorough due diligence, find good sponsors, and explore potential opportunities and risks prior to investing in any fund or other alternative investment. If you're interested in learning more about real estate and syndications, and how they can help you achieve financial freedom, join the Nima Equity Doctors Investing Club today. You'll find the link down below in the description. Finally, if you like this video, please hit the like button below, share with a friend or colleague, and be sure to subscribe. I'm Harry Nima Zegara with Nima Equity. Thank you so much for watching.